Welcome to SeizeYourBusiness.com. My name is Kevin O'Flaherty from O'Flaherty Law, and I'm here with my co-host Jim Waszak from Success Enhancement.
Hello.
And we're joined today by Tony Myers from Executive Benefit Options. And our topic today is going to be executive benefit plan. So he's just the guy to talk about this. Thanks for being here, Tony.
Totally. Thanks for having me, guys.
Yeah, we're happy to.
Pleasure.
So our executive benefits, is that designed more to retain key employees or as a way for owners to take extra value out of the business, or both?
It's actually a combination of both, Jim.
Okay.
So a lot of our planning is more discriminatory planning. The best way that I like to describe it is the fact that 401ks are very common in the marketplace today. Most companies have 401ks. They're considered qualified plans. So qualified in our world means that you offer it to one employee, you have to offer it to everyone. Well, some companies out there would like to discriminate. They want to offer a select grouping of employees certain higher level plans for, whether it be for attraction measures or retention measures, or simply to reward them in a different measure. These plans are considered non-qualified, which means you are able to discriminate amongst a certain segment of the work population.
What's the downside to being unqualified? Are there tax ramifications to qualified versus non-qualified?
Well, in the qualified world, majority of plans are tax deductible. And so most companies are looking for tax deductibility. That's the downside of the non-qualified world, is you still can't get tax deductibility, but you can get tax deferral and tax-free access in some cases. Or if these plans are designed especially for C Corps or for S corporations, money can be tax deductible in the future for the company, but you don't get an immediate tax deduction.
So the difference between tax deductibility and tax deferral is basically tax deductibility. If you put that into your plan today, that doesn't count as income on this year's tax return. And tax deferral is, it can grow. You pay taxes at the outset, but it can grow without being taxed every year or being taxed when you get it.
Exactly, correct. Okay. We have a lot of clients today who are looking at us saying, well, we do make significant income. We would like to defer money today if we can, but if we're maxing those options out in the qualified world, we're okay paying taxes today knowing that we may be in a higher tax bracket in the future due to higher tax rates or whatnot. So they'd rather defer the money or defer it today, pay taxes on it today, defer it down the road, and be able to take that money out more tax efficiently.
Well, if your money's growing every year, isn't tax deferral actually, when you game it out, isn't that the better option? Because you're paying a small tax up front, but if you're saving that tax up front, you're going to pay the tax on the larger sum later on, right?
100%. 100%. It really. I always ask folks I sit down with, would you rather pay taxes today and not pay them in the future, or would you rather not pay them in the future and then pay those taxes and not pay them?
Not pay them today and pay them in the
yes,
future.
Correct.
Okay.
Yeah. So I didn't know you could do tax deferral with plans like what you're talking about, because I thought only Roth IRAs. If you can get into a Roth IRA, that's a great way to go because it's tax deferred. But there's this 5,000 or so limit that you can put in every year. I didn't know there were other options for tax deferral, because
no question,
Roth IRAs are kind of like the gold standard if you can get in.
They sure are. Roth IRAs, in my opinion, are the best vehicles in the world for individuals. But when you own a business and you're looking to incentivize these top income earners or these key people of your organization, there are ways to set plans in place that are tax identical to a Roth IRA.
Okay. And so other than the tax deferral rather than tax deductibility, there's not really a big downside to being a non-qualified plan, right?
Well, the one negative of a non-qualified plan is it is backed by the full faith and credit of the company itself. So the one big negative is you want to make sure the company, if you're involved in one of these plans, you're a company that wants to put one of these plans in place, you should have a good track record, good cash flows, and have expected good earnings over the near future. Because if you don't, and you do go bankrupt as a company, the employee can forfeit those dollars.
Okay. And do you, when you're putting this together, do you need to see certain financials from the company to even qualify to have a non-qualified?
Yeah, I typically like to see the last 3 years' profit loss statements and balance sheets just to make sure that we're doing our due diligence and putting a plan like this in place for the company.
So it's kind of like applying for a loan. You've got to actually have good a good record in order to even put one of these non-qualified plans in place.
No question, no question. This isn't for everybody, but for the company that has, I always say if you've got if you're doing over a couple million in revenues potentially, you've got more than 5 employees, you've been around for more than 5 years, and you have a good track record of positive cash flows and growth, these are great plans potentially for those types of companies.
Yeah, let me ask you this question. Perhaps about the types of companies you serve. It would seem to me that there's, huge companies, Fortune 500 companies that have staffs of probably, accountants and lawyers figuring their best plans. And then there's the sort of startup who maybe just barely eking out an existence.
Yeah.
About where does a company have to be in, earnings or revenue or something where it starts to make sense to talk to somebody like yourself?
No questions. This is not a good plan for startup companies. You make a good point there. These are more plans designed for companies that are in their growth stage or maturity phase. By the way, almost every Fortune 500 company has non-qualified plans in place at some level. But the companies that we deal with, these are like manufacturing firms, service-oriented companies, IT-type companies. These companies, they're ones that have been around for around 5 years or more. You want to see track record. You want to see positive cash flows. You want to see the owners taking income from the company in order to justify being able to reward employees outside and beyond.
Got it. I just backing up to what you said that I made a good point. Just for the record, my points are always good. It's just a question of whether or not anybody recognizes it.
Sure.
So that was a little redundant. I just want to clarify that for our viewers. Can you tell us a story about an owner who came to you and he was kind of at the right point in his business development or her business development, and sort of what you were able to do for them and how they benefited?
Sure. So I've been working with a construction company for the last almost 5 years on the nose, and they were positive cash flow after day one. What they do is they go around, and it's a roofing and siding company. They have about 25 to 30 employees at any given time. There's 2 owners. They have branch offices in Michigan, St. Louis, and Kansas City, as well as here in the Chicagoland marketplace. We were sitting down with them about a year ago, and they said, we have these general managers, operators who are running these offices in these 3 or 4 different marketplaces. They're not owners. We don't feel like we want to give them ownership of the company. We've worked too hard to develop this, but we want to make them feel like owners. Is there something we can do? And that's when we started to dive in this conversation of these executive benefit type plans. And so what we've done is we've structured a plan for each of these 4 other individuals where it makes them feel like owners. They can act like owners, but they don't have actual equity in the company. So we've structured it such where there are stipulations that they have to meet in order for them to receive this money from the company. So there's certain profits they have to grow by each and every year, and there's such a time frame which they have to stay with the company before they can receive these dollars that the company is investing on their behalf.
Got it.
So the way that works, the company would put the money into the plan only if they hit these certain benchmarks.
That's correct.
And then once the money's in the plan, it doesn't actually vest until they've stayed for a certain amount of time.
Correct. We call them golden handcuffs. It's a simple, easy way for a company to select some key individuals and kind of tell them we like you. We want you to stick around. You do great work. We don't want you to leave somewhere else. And so this is a form of a retention plan that allows them to contribute dollars on the employee's behalf. And the employee has to stay for a time period. In this case, this company, they chose for them to stay for 5 years. Last year, they made significant contributions to the plan. This year, we're meeting actually on Thursday to discuss additional contributions based on how the company performs.
So for that kind of plan to work, it sort of sounds to me like the ownership would sort of have to let the people know how they're doing. So if it's somebody who wants to keep that quiet, is that an issue for them?
It certainly is, because you do have to somewhat open up your books to those individuals. You don't have to open up fully, but you have to open up enough if you're going to allow them, especially if you're going to build in a reward based on percentage of profits. Some folks say we'll do it based on a percentage of your income. forget about profits. If that's the case, books don't need to be open. But you're right. We're dealing with an architecture firm right now that is designing one of these for 3 of their top people. And they were a little leery about opening up their books, but after talking with their accountant, we've decided that they need to open up their books for these select individuals.
Oh, so if the person leaves before the 5 years and the money's already in the plan, I assume that doesn't get paid back to the employer. What happens to the money that doesn't end up vesting?
Well, it depends on how the plans are structured, but actually in the majority of these plans, it does go back to the employer. So they're informally funded by a trust typically, and that money remains in the company coffers. So if the employee does not meet certain vesting requirements or periods, that the company can retain those dollars and give them to someone else or use them for their own benefit in some other way, shape, or form.
I know you can do golden head cuts with 401ks and do the same sort of vesting options.
Yeah.
What are kind of some advantages to doing, other than being able to select particular employees that you wouldn't be able to do with a 401k? Are there other advantages or flexibility doing it in a non-qualified plan like you're talking about?
Good question, Kevin. So the 401k, because it is a qualified plan, you are limited to the amount of money that you can put in either by the individual or the employer. With a non-qualified plan, there's really no limitations. So
and it still grows tax deferred?
Still grows tax deferred. So if the business owner let's say the employee is putting in $18,500 into their 401k, they're maxing that out. Let's say the employer has a 6% company match, which is very generous in today's world, but they want to give this employee another $25,000 a year on top of it. They're able to do that in this non-qualified world.
Wow, you didn't see this if you were just listening to the podcast, but my eyebrows raised like almost off my head when you said you could put basically unlimited amounts of money in a plan.
The government, it's governed by 409A and ERISA laws, so it has to be deemed reasonable compensation. So if you have an employee that's making $50,000 a year, you can't give them $50,000 as an additional bonus. But if you have an employee that's making $100,000 a year and you want to give them $25,000 or $30,000 as an additional deferred compensation bonus, you can certainly do that.
Can the business owner put as much as they want, assuming it's reasonable towards themselves, without having to be tied to the same amount for the other employees in the plan?
They certainly can, but some issues arise in terms of how the company is structured. If it's an S corporation, so if it's a pass-through entity, it makes it more challenging to get the tax deferral, because maybe you get the tax deferral at the company level, but it flows to the business owner as a taxable billable item. So it's sort of a wash for an S corporation or flow-through. If you're a C corporation, it works 100% of the time.
Okay.
Yeah.
So how do the setup costs and the annual maintenance costs for a plan like this compare to those of just doing the company 401k?
They're almost identical to a 401k. When it comes to the compliance and oversight that needs to be done in the administration of it, it's identical to a 401k.
So if you can qualify for one of these through your financial statements, I'm not hearing a big downside to doing this over a 401k. Am I missing something?
Again, the only downside is the fact that the money is tied to the company's coffers. So if the company fails in a 401k, no one loses their money. But in this plan, there's a potential you could lose your money if the company were to fail or have some financial issues.
Oh, go ahead.
What about setup costs? Assuming a company has nothing, is there a lot of legal documentation that people have to complete, or is it pretty straightforward? What is my sort of administrative cost if I want to set one of these up?
Yeah, so the administrative cost is typically similar to the 401k. It's based on the assets that are being put into the plan. Mm-hmm. So if you're putting away, let's just say, $50,000 a year total into a plan like this for a number of select employees, your administrative costs will probably be somewhere in the neighborhood of $1,000 a year. So again, it's very similar to a 401k startup.
But when you're first doing the original paperwork and everything, isn't there any legal fees or anything?
So great question. There are legal fees typically. We try and make those legal fees easier for the client because we've done so many of these. Mm-hmm. We have templates that we can give to a legal team so that it can be very streamlined and templated, and so hopefully it'll save that client money on legal costs. But certainly you do need a qualified attorney, a business attorney, or any attorney that can draft the documents, no question.
When you talk to a business owner prospect, do you get the reaction kind of like Kevin had with your eyes popping out? Just, wow, I didn't realize I could do this. Great, or
I would say probably about 50% of the time we get that. Yes, they haven't been. A lot of folks we met with just haven't been educated enough. They've been told about a 401k. They've been told about simple IRAs. They've been told about all the group benefit plans that are out there. But this is one area which there just aren't that many advisors well versed in this area of the marketplace. And so these are very select, very detailed plans that you need to have a well-versed knowledge of the planning, of the tax laws that are involved. You have to have a good legal team on your side as well. But yes, we do get that reaction because they aren't always as well known as a 401k would be.
If clients sit down with you, do you talk to them and advise them about 401ks and SEP IRAs and stuff like that too, or are you strictly limited to the non-qualified plan?
No, yeah, so that's a good question too, Kevin. Our business model is such that we do help audit with the 401ks, group health insurance, group disability. We'll do succession planning for companies. We also help audit buy-sell agreements for these folks, and then we'll do valuation analysis at times as well. Work in coordination with their accounting and attorney team to do valuation analysis. But yes, we do audit 401ks and help administer those if need be.
Is there any upside other than just having one person that you're working with to somehow tying your insurance benefits that you're providing, your health insurance benefits that you're providing your employees with the retirement benefits, doing that through one company, or does it not really matter?
It doesn't really matter. The health insurance world has become so fragmented over the last number of years with the new ACA laws that typically I always tell my clients you actually probably want your health insurance separate from your retirement plans, because you don't want the company that's monitoring your insurance products to be dabbling in the investment world as well. You want that to be somewhat separate.
Are there other than the non-qualified plans we just talked about, are there other executive compensation strategies that you talk about with your clients?
So all executive comp plans are non-qualified. Now, non-qualified, Kevin, is more of a generic term. It then breaks down into further subcategories, such as deferred compensation plans, Section 162 bonus plans, and SERP plans. Those are the three major other types of non-qualified plans.
Can you give us a real quick and dirty explanation of what those three things
are?
Oh
boy, sure.
If it's too much to cover in a couple minutes, then
no, I sure can. I can do my best. So all these plans, a non-qualified plan is all based on how much control that a company desires to have over the plan itself. A SERP plan, which stands for Supplemental Executive Retirement Plan, the company has the utmost control. They are able to dictate when the money is put in, when the money is received. They actually have a cost recovery mechanism in place as well. So if the employee leaves early, passes away, you name it, they get all money refunded back to them through this plan. So they have ultimate control. Because they have ultimate control, it also means that these plans, all that money is on the company's books. So they are the plans that are the most susceptible to creditors if anything were to happen. The next step down is deferred compensation. It's where the company has somewhat control over it, but not nearly as much. So therefore, only about 50% of the plan is on the books from a creditor standpoint. The other 50% is off the books and is more free-flowing and can be used. So there's more employee control of the plan versus the employer. Thus, you have less creditor protection.
Okay.
Or creditor accessibility. Then lastly is the bonus plan. The bonus plan, the company has very minimal control over that. There is no cost recovery mechanism in a bonus plan, so you can put a vesting requirement like a 401k on these plans, but at the end of the day, once the employee hits that vesting schedule, even if they're no longer with the company, they still have access to that money.
Okay. If someone wants to meet with you and talk over their options here, how can they reach you, Tony?
Yeah, they can reach me at anthony.myers, that's MYERS, at N as in Nancy, M as in Mary.com. You can also go to our website, it's executivebenefitoptions.com, and just look for me. I'll be on the front page. And or they can also call me if they'd like. It's 630-353-2682. 630-323-5355.
And you can reach me at 630-324-6666. And again, my name is Kevin O'Flaherty with O'Flaherty Law. And Jim, how can people reach you?
630-272-3895. Success Enhancement, Inc. Thank you very much.
Thanks, Tony.
Thank you,
Thank you,
guys.
Tony.
Much a pleasure.